Forecasting how the heck to pick a mortgage rate in almost any market is challenging. And when you throw in the economic uncertainty that we are facing already in 2025, you need some type of a time-tested strategy to be able to decide and decipher whether or not it makes sense for you to go fixed or variable or short-term or long term. If your goal is to try to figure out which is the best option to go with, then you're at the right place and you're watching the right video. I'm going to walk you through a framework that we use to help people not necessarily self-select, but come to a much closer place as to deciding whether or not one mortgage option makes sense more than the other. Now, whether you're watching this in the beginning, the middle, or the end of 2025, it really doesn't matter because this framework will make sense for you. So stay tuned and we'll explain to you exactly how it works. Now, the popular opinion around Canada's economy right now is that really the economy itself is kind of circling the drain, but that's inconclusive and the market could change on a dime, as we obviously already know. With our Prime Minister already deciding to step down and so much economic turmoil happening in the United States, the market's going through a pretty dramatic shift right now. And with that being said, there are a lot of potential things that could drive rates up or down. So how you make a decision is very difficult right now. But again, we'll talk about that framework. Think about all the things that could lead to disinflation. We talked about these before. We've got population drops. We've got a tariff threat. We've got AI productivity. We've got towering household debt. We've got slower economic global growth. We've got a painful mortgage renewal coming up for folks who are seeing rates go from 2% to 4.5% or 5%. But on the flip side, of course, we've talked about this in our last video, which is inflation. We've got monetary stimulus. We've got threatened tariffs that we talked about, go the other way around. We've got AI-related business investment. We've got looser lending guidelines. We've got a diving dollar in Canada. We've got a spillover of economic growth. We've got the potential of real estate resurgence. So there's a lot of things that could impact rates, both fixed and variable rates. So this is what we're going to do. We're going to walk you through this framework and help you make a decision despite all this other stuff that is happening in the marketplace. Let's get into it. So this is an acronym that I call P.R.E.P.A.R.E, and here's exactly how it works, and you can use it yourself. So this is how you start your initial assessment, trying to determine what makes sense. First and foremost, the P.R.E.P.A.R.E framework itself is basically a step-by-step process to helping you decide between a fixed rate or a variable interest rate or any other comparable solution. It's not meant to go into advanced strategies like the Smith maneuver or cash damming or anything of that nature. The primary focus is to help you make that fixed or variable rate decision, or at least put you in the right camp. It considers key goals that you have: financial stability, your work, your risk tolerance, and of course, it's there to provide you with a clear solution, at least a framework to helping you make the decision. Let's get right into it. Section 1, let's talk about that P for P.R.E.P.A.R.E. It is payment stability. Now, obviously, this is something that many people think about, but a lot don't. And the first thing you need to understand is your payment preferences and how your payment preferences impact your choices. So when you're thinking about your two options, you need to be thinking about whether or not payments themselves are important to you. For some folks, payment stability is the absolute most important thing. And this doesn't necessarily mean that you have to take a fixed rate mortgage, but because you could potentially choose a variable rate that has a fixed payment. But when you're determining which type of mortgage product you're looking at, you need to be considering whether or not are you comfortable with fluctuating payments, or do you need that predictability? If payment stability is important, then it's obviously going to be a fixed interest rate or a fixed payment variable rate. The second one, R, for risk tolerance. Now, that word risk scares the crap out of a lot of people because it sounds like 4% increases over the course of 12 months, which is what just happened. But let's be honest, that's not always the case. And if you're thinking about a scale of 1 being zero risk and 10 being the ultimate risk right here, most people usually sit between a 4 to an 8, somewhere in that ballpark. Rarely do I see someone who's a high 8 or a complete number 1. But you need to figure out for yourself where you fit on that scale, because that will help you determine what type of risk you're willing to put up with. Are you willing to deal with the risk of a potential payment or an interest change? Or on the flip side, let's say in the case of a fixed rate, are you willing to risk the fact that you could be paying a massive prepayment penalty to your bank, an IRD penalty, if you wanted to restructure your loan, sell your property, or try to drop your rates in the middle of a term? So that would be our risk tolerance. Variable rates can save you money long term, but they do require some short-term volatility. Depending on your personal comfort, you need to make that decision. Okay, so the question around E is equity and emergency funds. Do you have sufficient amount of equity or savings to manage any unexpected financial challenges. You see, what we typically recommend is for someone to have at least 3 to 6 months of savings set aside for an emergency situation. And ideally, you have 10 to 20% minimum equity in your property if you need to sell that property or get out of it. And if you need to refinance, then you're looking to have at least 30 to 40% equity in that particular property for that benefit. In the case of any type of emergency situation, whether you're going fixed or variable, you need to be considering your emergency situation and your equity. P, plans for the future. So if you're planning to move, refinance, maybe take time off, maybe pull equity out of your property for an investment, any other restructures throughout the term, or take advantage of potential rate drops, fixed rates can come with significantly higher prepayment penalties than variable interest rates. And of course, that can impact your desire to make the decision on a particular property, because instead of paying $25,000 on a $500,000 loan, you're paying $5,000 for a 3-month interest penalty on a variable rate loan. I've seen so many circumstances where people took a fixed rate mortgage because, well, they didn't have risk, but on the flip side, they knew that they were going to move and ended up paying a pretty significant prepayment, and it cost them a lot more money than any increaser in variable rates, purely because of the fact that they were not comfortable with any risk, but they didn't think about their future. Next one is affordability. We need to think about the fact, like, does your job, first and foremost, allow you, and we'll talk more about income in a moment here, but does your job allow you to have any flexibility? Does the amount that you're borrowing as a percentage of your income give you any flexibility? Can your budget handle higher rates for any extended period? Have you worked out scenarios where rates increased for 18 months by 1 or 2% higher than where they are right now? So you need to think about it from an affordability perspective. If your debt to income ratio is too tight, then maybe you couldn't deal with any increases in that capacity. Rate cycle position. Okay, so where do we stand in a rate cycle? We know, typically speaking, looking at historic rate cycles, if we're at or near the top, if we're coming down, if we're near the bottom, generally speaking, we have a range of where we are at a particular time on a rate cycle, but we don't know if it's going to be for 6 months or for 6 years. That being said, depending on where you are, typically speaking, variable rates perform the best in declining rate cycles. So somebody who took a variable rate in the last 8 to 10 months is probably going to do pretty darn good when you consider them comparing against a fixed rate loan that was 5.5 or 6.5% at that time, even though the variable rate was higher initially. Variable rates have come down quite significantly from the peak, and so we are on the downward trend of that cycle. We might be halfway through it, we might be 3/4 of the way through it, and depending on who you talk to, we might not even be a quarter way through it, but we are on the downtrend of that cycle. And so knowing where you're at as it relates to that cycle is very important. And your employment stability. Is your job very secure? Like, are you the type of person that can deal with recession around your type of position? Like, do you work as a police officer, or do you work in a position that is virtually guaranteed a raise every so often and you're not going to be out on income? Or are you working as an entrepreneur that doesn't know what their income is going to look like year over year over year? Economic uncertainty will impact your employment, and understanding where you stand is going to be very impactful. If you're someone, again, who has no stability in your job, then you're probably going to look for fixed rate stability. If you have a lot of certainty, then it's much easier to plan for the ups and downs of a variable rate mortgage and take advantage of that. That's the framework that I would recommend you consider when you're trying to make a decision on a fixed rate or a variable rate. And you can use this framework in any time frame. It doesn't matter if it's 2021 or 2025 or 2028. It helps you to frame up where you should be and what the different types of factors to consider as it relates to your mortgage are. If you found this information helpful and you'd like to chat more with the team, hit that link below and give us a thumbs up if this was helpful for you. Enjoy. See you later.